The mortgage industry is changing, and it's actually changing for the better. But the good thing is private money is starting to come into the market. We now have a non-warrantable condo project, which basically, condos are difficult to finance. We now have financing up to 80% on condos. The project doesn't have to be complete. The builder could still be in control of it, could have mixed use with commercial. The guidelines are a little stringent, you know, for 80%, finance just 20% down, where typically it's 30% down. You do need a credit score of 720 to get that. As your credit score drops, the loan to value drops. The people who haven't come into this market are the 24 to 38-year-old. Some of them are afraid because they're psychologically damaged. They saw their parents lose their home and their life's disrupted. But they're coming into the market. And these are the people who are going to need financing. You know, they're not sitting on the nest egg to buy the retirement home. And where right now, that's probably, and nationally, it's 28% of the market, and typically it's 40%. These are the people that are going to be coming in. So the young buyers are really, not the only, down here, which we've got a lot of old people, but we're starting to develop a lot of industry in Florida, and there's going to be more and more of a need for these people. And they're under the misconception. I have an article here from the vice president of Freddie Mac. Most young buyers think they need 10, 20% down to buy a property. It's not true. You know, there's programs, USDA, if you're in the right area, it's 100% financing. FHA, 3.5% financing. Conventional's 5% financing. So what I'm saying is there's a lot of new product coming out. There's a lot of things changing, and the thing I'm excited about is the private money that's coming in. And I wanted to talk a little bit about the 203K, and what brought this to mind was I was here last week for the first time, and I forget the gentleman who was sitting over there, and he presented a property, and he had an issue with a kitchen. He didn't like the way the kitchen looked, the tile. It seemed like a couple of $1,000s could have really made a difference. With the 203K, you can finance from a minimum of $5,000 on up. You can Chinese drywall. You can go into the house, you can rip out the Chinese drywall, you can remodel a whole house. There's only a few things that you can't do with a 203K: swimming pools, spa, fire pits, luxury items. You can completely gut the house and redo it. Rip out a kitchen, rip out a bathroom. So I have some pictures here I could show you before and after. It's a complicated loan. The house is sold. You have to, it's basically, it's like a hybrid construction loan. You have to have all your bids, your plans, your contractors put out, your insurances, etc. And it's done over a period of 1 month if it's a simple granite countertops and new tile floor and spending $5,000, or you're completely remodeling and putting in $150,000 into the house. Your first 6 months of principal and interest are built into the loan. So a lot can be built in. And this is someone, you have this house, it's sitting there, it's in a great neighborhood, it's a wreck. Or it's not but it's where the person wants to live, but it's not the house they want. You can make it the house they want, and the financing's available for that. It could be almost anything, from minor repairs, if it's just paint and carpet, all the way down to a complete rehab. The luxury items that are not allowed, and they're just that's very simple. You can't put in a swimming pool, spa, or a barbecue fire pit. You have the house as is. Then you have the construction plan. The appraiser has to look at it like it's a construction loan. Like here's the lot, here's the house. It could be 2,000 square foot. You could be putting on an extension and making it a 3,000 square foot. You're going to be ripping out the kitchen, new tiles and granite countertops. And the appraiser calculates all these in, and in the end, it's going to be worth X. We will lend 96.5% of the end result. So the house may sell for 150, and the person's putting in 150. If the value and if it warrants a value of 300,000, we'll lend 96.5% of the 300,000, not of the 150 for the cost of the home. So the cost of the home plus all of the improvements.